Hello and welcome to BK Prama. I'm here Aldadia. A lot of movers and shakers in trade today, a lot of sectors that are in focus as well. And it's a Monday. So, how the week is going to be interesting. Joining us on the show is Sanjeev Hota, Senior VP and Head of Research at Sharekhan-BNP Paribas, joining in. Sanjeev, good morning and welcome to the show.
Thank you.
Sanjeev, let's start off with a couple of sectors which are very interesting. Let's pick up FMCG as a whole. Clearly, if you see in terms of FMCG, of majority of the companies that have reported numbers, it's a pretty mixed bag that we've seen in terms of volume growth. But what next is going to be important, and whether it is the right time to enter FMCG names, taking the valuations into consideration. What's your read, and what would you advise?
Yeah, so if you see till now, there's a two part of the story. Firstly, on the rural focused FMCG staple company, that are not very good in terms of numbers for the Q4. But at the same time, some of the companies which are focused on foods or hair oil, they are delivering good set of numbers like Marico or Bajaj Consumer or Britannia per se. But at the same time, as you rightly said, that some companies like HUL or Dabur India, they have disappointed for this quarter. And mainly because of this rural demand is not picking till now. But my sense is that our interaction with the management, it's clearly they are stating that the rural this pressure is clearly bottoming out at least. And at the same time, there's a correction in the input cost, and that is going to augur well for the margins for this company. But most of them are betting on a good monsoon to come in. So if the monsoon is going to good, the tailwind is there for the RM side. So definitely we would see better numbers going into FY24. But currently we have a neutral stance on the entire consumer staple sector, and we are more positive or selectively preferring companies like Britannia, Tata Consumer, Bajaj Consumer, and Marico. So these are our top pick currently.
Right, so that's with regards to the FMCG space as a whole. Moving on, you have tire stocks which are seeing an interesting move. In fact, last week, majority of the counters have been up in that range of 7 to 20%. And interestingly, you have MRF which has hit a record high. The stock in the futures market has hit 1 lakh, and this is for the first time that we've seen that happen with MRF. Taking the numbers into consideration with what's happening with tire companies as well, what's your view?
Yeah, there's an interesting thing that is happening for the tire sector before going into this Q4. The estimates were quite modest in terms of the margins or the volume growth. But if you see the MRF or C8, they have reported a very strong set of numbers. And in fact, for MRF, their gross margin expanded by almost 490 bips and entirely driven by the soft RM prices. And also the demand improvement is happening. For the C8 as well, if you see the volume growth has been at 7% Q on Q, and that has been like recovery in export segment, and the replacement demand is also improving. But the story of this sector entirely lies in the RM, this correction. The rubber prices has been correcting, and that is reflecting in the improvement in the margins for all this company. So I believe that some of the companies that we like in this sector, like Apollo Tires, that I think is going to deliver good set of numbers, and the estimate are still very modest for this company. And with the kind of recovery that C8 has delivered in the export market, I believe that augurs well also for the Apollo. And I think Apollo is going to deliver a good quarter this time. And the valuation, if you see, at 13 times FY25 is still very, very reasonable. So I would suggest that investor looking out for a good company at reasonable valuation in the tire space could look at Apollo. We have a target price of 372 here.
Right. So that's 372 target price coming in terms of where Apollo Tires goes. Moving on, overall, if you see in terms of other names as well, Sanjeev, a lot of movers and shakers coming in there. IndusInd Bank is an interesting one. What would your view be with an IndusInd Bank?
So for Q4 per se, the numbers are quite in line, nothing on the negative surprise side. And more importantly, if you see the headwinds are coming down for this overall IndusInd Bank. And going forward, if the mobilization of retail and granular liability accelerate, I would believe that could trigger into the gradual re-rating in this stock. And as far as the news goes for the CRO resigned, I think this is a normal business case for any companies or any bank, and it's unlikely to have any significant impact on the earnings outlook for the IndusInd. And the valuation, if you see, it is 1.4 times FY24 book value, and ROA trajectory of almost 1.9%, 2%. It still looks reasonable for IndusInd. So I think this current weakness is the opportunity for the investor to buy into this. And we have a target price of 1400, and in fact, we have a buy rating on this company.
Right. Moving on, Coal India reported numbers as well. And if you see the profits, that has actually dropped because the wage cost provision has jumped almost 12-fold. And clearly, the surge in the staff wage provision is eating into the revenue gains as well. However, Coal India has always been a dividend play. What would your view be with the Coal India?
Yeah, you rightly said that this quarter has been a very disappointing for Coal India, and that will be driven by the higher this provisioning they have made for the employees, and which has led to almost 36% miss in the operating profitability. But I think the dividend play is still there for the Coal India this year. If you see entire FY23, they have declared a dividend of 24, which translates into almost 10% dividend yield. And the stock is available at 4.7 times FY25 EPS. Although near-term concerns are still there for the FSA realization and lower e-auction prices, but I think the current valuation offer good risk reward for an investor who is looking out for a good dividend paying company. For that matrix, we are positive on Core India, and we believe it still looks solid in terms of investment case going into next 12 to 15 months.
Right, so that's Coal India. Moving on, TCNS is an interesting one. In fact, the stock has crashed almost 19% in trade, and this is after Aditya Birla Fashion is going to acquire majority stake in the company. Now, clearly, taking the open offer news into consideration, the swap, the ratios into consideration, what's your take, and what should someone do who is holding a TCNS as well as Aditya Birla Fashion, or either of them?
So this is a very interesting inorganic growth that Aditya Birla Fashion has done to create their ethnic collection or ethnic brand they are building over the past few years. For the valuation part, I think ABFR has not paid any major premium for acquiring this total shareholding of TCNS. But having said that, definitely the TCNS stock has run up, and now if you see the swap ratio of ABFRL to TCNS, it is more favorable for ABFRL than TCNS. So my suggestion would be for anybody who's holding TCNS to go for tendering their share on this open offer platform. And for ABFRL, I think it's the long road ahead after acquiring TCNS, because TCNS portfolio is not done anything great in the last 3-4 years. The CAGR is only 8% in their revenue. So we need to see how the ABFRL management is going to accelerate or rebrand it and do something like better in the TCNS portfolio. But the valuation wise, I think ABFRL is at a very reasonable risk reward juncture. So one would continue to hold for ABFRL. We have a target price of close to 270 rupees. So the current risk reward is more favorable for ABFRL.
Right. And very lastly, the last stock that we should be discussing is a Maruti from the auto space. In fact, nearly after 4 to 6 months, the stock has managed to close the 9,000 mark in trade. On the revenue front as well, it's been pretty much ahead. Overall, what do you make of it? Because brokerages are turning positive on Maruti from here on.
Yeah, sure. So we are also positive on Maruti. If you see, the Q4 was the second consecutive quarter where Maruti has delivered a margin above 9%, and it's driven by favorable product mix and gross margin expansion. Going forward, the management is focused on launching the new SUVs and CNG variant to regain their market share. They have lost market share in the last few quarters, but I think with these new launches coming in, the penetration will improve outlook looks positive for Maruti, and along with that, the RM tailwind is there. The costs are coming down, so that will augur well for the margins for Maruti going ahead. So we have a buy rating for Maruti. We believe it's a structured story for to play for the India auto market, and we have a target price of almost 10,965. So I would recommend buy on this stock for investment.
Right. So that's with regards to Maruti. So that's going to be an interesting play as well. Thank you, Sanjeev, so much for joining us on the show and giving us those views on the movers and shakers of the day as well. Thank you. Stay safe and speak to you soon again.
Thank you.